Thanks very much, Ricardo and Dana. And good morning, everyone. So we now turn our attention to scanning the horizon to consider IAIS priorities for the second half of this decade. Specifically, the IAIS has launched a process to develop its next strategic plan, which will guide the work of the association from 2025 to 2029. It will replace the current strategic plan, which concludes at the end of 2024. The IAIS has made strong progress against the objectives set out in the current strategic plan. Many elements of the strategic plan have already been achieved, and the IAIS is on track to complete all objectives across its high-level goals by the end of 2024. Now the task ahead is to cast our minds forward to consider the key risks and trends facing the insurance sector in the next 5-year period and develop a plan for how the IAIS can best support supervisors to navigate the challenges and opportunities these risks and trends present. To guide the development of the strategic plan, earlier this year we established a task force to oversee this process. Currently, we're engaging with both our members and our stakeholders to elicit input into the strategic plan. On Monday this week, we launched a stakeholder survey, and you can see the QR code up there on the screen. And today we're very privileged to have not just one, but two panels to discuss these issues. The first panel will focus on the IAIS's high-level goals 1 and 2, which focus respectively on assessing and responding to market developments and on standard setting. And our second panel will focus on the high-level goals 3 and 4, which focus on sharing good supervisory practices and on the observance and implementation of standards. So this is a once in every 5 years opportunity to shape the work program and focus of the IAIS, so we would encourage all our stakeholders to actively participate and share your thoughts through the survey and the panel discussion. Over the course of the next few months, the task force will continue to develop the strategic plan, taking on board the feedback received from members and stakeholders. And we plan to share a preview of key elements of the strategic plan during the annual conference in November.
And we've got a great panel here. And for panel 1, as what has been mentioned, this is going to be a 2-part panel, and Peter Brommuller will be moderating the second part. What we're going to be looking at on panel 1, what we want to do is focus on assessing and responding to market developments and standard setting. And it's in the context of the IAIS priorities for 2025 and beyond. We've seen on the previous panel a look at some of the short-term and medium-term risks. We're going to look at the risk going out probably at the start. We're going to look at the next 5 years or so. Just to let you know, and I'm sure we will see it on screen shortly, there's going to be a Slido polling question that I'm going to ask you to respond to. And as you can see, I think it's on there. Yes, it is. What do you believe will be the key risk in the insurance markets in the second half of this decade? And just in terms of just to keep this going, what I'm going to do is start with my panel, because I would like to hear from my panel what they think. I'm going to read a whole bunch of risks here. And while they do that, if you could start answering on Slido. Also for this panel, what we will be doing in terms of audience questions, and I'm hoping we get time for some audience questions, is that we will be taking them on Slido. So it's hashtag IAIS 2025. We're looking forward to 2025. So please, if you use that hashtag on Slido, you can submit questions as we move along. So the polling question options that you will see for the key risks in the insurance market in the second half of this decade. There's climate risk, there's credit market risk, demographic risk, geopolitical risk, liquidity risk, monetary policy and inflation, reputational risk, the risk that your current moderator will simply go crazy and start doing things that the market can't handle, but in general, any other risk. And let me start off with Susan Neely from ACLI on my far left. What risk most concerns you?
Well, that's a big question, and I would first say I here as the CEO of ACLI, but more importantly for this kind invitation to be on this panel, I am the current president of the Global Federation of Insurance Associations. Most of you may know who we are, but we do represent 67 countries around the globe, 67 insurance associations. That's a lot of expertise, experience, and brain power. So I will do my best to reflect just a bit of that in this conversation, because we are very pleased to be able to provide some input to this. I think I resonated with Cecilia's comment in the last panel when asked about the risks, because she said they're interconnected, and that's certainly true with the ones that you just listed, Commissioner Mais. For the purposes of this discussion, though, I want to elevate the whole notion of demographic risks, because that is the one that is very customer-consumer facing, and I think that's got to be just a bedrock. I know it is a bedrock of focus for supervisors around the globe, and it is also a bedrock of focus for insurance companies and the members that we represent. This is why the Global Federation of Insurance Associations invested in the development of the first global risk analysis of protection gaps facing consumers and people around the world. Our core responsibility is risk management. Our responsibility is to the policyholders we serve, and we felt this was an important sort of intellectual contribution we could make to this kind of strategic planning that IAIS is doing, and also the focus of our member companies and policymakers and other stakeholders who have a role in addressing these gaps. To give you a flavor of it, we focused on 4 protection gaps: natural catastrophes, pensions, cyber, and health. For each of these, we put a dollar amount in terms of the cost of the risk to society and the globe, nothing like a dollar amount in the billions and trillions to help focus one's attention. We identified the trends and factors that are contributing to the risks for each of them. We looked at policy levers that have been adopted around, in different jurisdictions around the globe to help tee up solutions that can be considered. We offer case studies, all with an eye toward advancing both focus on these major gaps and also the work to solutions. A couple examples, first with natural catastrophes, which shows up in its relation to climate risk in respondents to the last round of risks. I'm sure it will rank high today. We looked at, again, the factors contributing to that. The cost of natural catastrophes is at $139 billion annually. They've been increasing at a rate of 5% each year for the last 50 years, and the last decade has been the most costly in terms of natural catastrophes. We looked at policy levers. Certainly insurers can do what they do well, create natural catastrophe risk modeling, but we think there's also an important role for policymakers to do more in this space as a way to address this critical gap. Pensions, the largest, most costliest of the gaps, $1 trillion annually. We all in this room know the factors: longevity, people living longer, GDP continues to rise around the globe. This means standards of living are rising, but also people's expectations of how they will live in retirement. And we have fewer people being born, so fewer people, workers, paying into government pension schemes. It creates this sort of perfect storm, and we only expect to see that gap grow. Insurers are doing their work with innovative products, financial education for people, but again, there's more policymakers can do related to things we see working, tax credits, or automatic enrollment in retirement savings vehicles. So just a flavor of our report. You can download it yourself at GFIA.insurance.org. But I would just, to bring it back to what can supervisors do, because I know that's core to the question, one of the needs we feel in the insurance industry is that supervisors can be enormously helpful in educating policymakers wherever appropriate, who don't have your understanding of insurance and how it works, who don't have full awareness of the factors contributing to some of these gaps, and we think supervisors have knowledge, standing, credibility, and can be very helpful as we seek to get more attention. Again, as a whole of society approach, all stakeholders, many stakeholders have responsibility to help address these gaps, and that's the point of our report, but in particular on the policy-making side.
Susan, that's an excellent report from Jafia, by the way. Got a question, a follow-up question for you, if you don't mind. As we sit here as regulators with access to those policymakers, if there was one thing, because as you mentioned the different gaps, I'm thinking pensions, there's a big demographics concern, as you mentioned. There are some externalities that we really don't control. What would you want us as regulators? What single message should we convey to policymakers?
Well, I think maybe the core message is to help create a greater understanding of how insurance works and how we manage risk. I say this with someone who worked in a governor's office and has worked closely with legislators. I've worked in Congress. I think establishing that understanding of what insurance does and doesn't do, why we're different than banks, why we're different than other forms of financial investments, that's probably the core thing or the foundational thing that supervisors could do to help inform the policy-making process. If we get into each of the risk gaps, I'd say with pensions, which is what I spend a lot of my day job on, it's automatic enrollment. I mean, we have proof that that will dramatically increase personal savings for retirement. So we could go through each of the 4 risks and identify the one thing, but it starts with better understanding of a complicated industry on the part of policymakers.
Thank you, Susan. Stefan, you are the Chief Rating Officer for AM Best and is such of vital importance both to regulators and to the industry. Let me ask you, looking at those risks, how do you think the global risks are going to evolve by the end of this decade, so by 2030? And what is this going to mean for insurer balance sheets, A, and for their business models, B?
Great, thanks, Andy, and thanks to the IAIS for the opportunity to join the panel this morning. For any of you who aren't familiar with AM Best, we're a global credit rating agency solely focused on the insurance industry. So we provide financial strength ratings, credit ratings, and debt ratings for insurers and reinsurers in over 100 countries. And I'd like to frame out my commentary on both the risks, but also to some degree the opportunities that are out there associated with the risks that we're here to talk about this morning, and also make the point that the insurance industry is highly resilient and highly adaptable to changing conditions and able to apply the lessons learned from prior crises, whether they be catastrophe events, financial market meltdowns, liquidity crises, wars, or pandemics. And another overarching comment I'd like to make is, as we talk through these risks and opportunities, it really emphasizes the importance of enterprise risk management, governance, and board oversight, and really the ability to identify the early warning signs and react to them appropriately. So I wanted to kind of set out 4 risks that are alive and well in the market today, but I feel will really be growing in importance over the course of the remainder of the decade. And I should say that my colleague at AM Best has signed out our crystal ball, so he wasn't willing to kind of hand that over to me. So I really don't know how these 4 risks, to kind of that specificity, how they will play out over the course of the next 5+ years, but I do feel that they will be kind of growing in importance and really front and center on insurance organizations' radar. First of all is climate risk. I think we had some good discussions around that yesterday, but without a doubt, we're seeing more frequent, more severe events, both primary and secondary cat events. We have kind of to the demographic factor, an increased asset concentration and greater policyholder concentration in high-risk areas. And frankly, the vendor models, the CAT models, are having a hard time keeping up with these changing market conditions. So certainly a main risk there that is not going to go away. Cyber, both from the aspect of insurance organizations protecting themselves from attack, as well as those insurance organizations that choose to underwrite cyber exposures. The demand is going to continue to increase, and the modeling around cyber, similarly to the way we saw it evolve on the Nat-CAT side, we really need the cyber modeling to capture PMLs so insurance organizations are able to manage their gross and net exposures. I think the prior panel identified how unique in that sense cyber is, where it doesn't have to kind of be bound by geographic borders. So a real challenge there, but again, also an opportunity for the industry to satisfy that demand. Two more, innovation. The insurance industry, through our questionnaire, admittedly lags other industries in terms of adopting modern technology, digitalization, yet the customers are demanding that experience. So I would flag that as a potential disruptor to the insurance industry, and for those specific organizations that are not able to leverage technology and innovation, they may find a competitive disadvantage. Final risk, probably a little bit more US-centric, but I do feel that the US has a habit of exporting things globally, sometimes good, sometimes bad, and this one is social inflation. Here we're talking about runaway jury awards, nuclear verdicts. Litigation finance is growing like wildfire, and what that means is more first-party claims going to litigation, which means more costly insurance policies for those seeking coverage. Florida, I would say, is a great example of what can happen when the trial bar is allowed to game the system. And I think kind of to your question just a moment ago, it's a great opportunity for the regulators to work with legislators and really try to kind of find that appropriate balance to protecting the consumer, but kind of avoiding these runaway jury awards that's making insurance more costly for every policyholder.
Thanks, Stefan. Chad, you're the managing director of the Geneva Association. You put on some wonderful conferences yourself. And certainly the last one I was at, I found it really informative. You've got a variety of viewpoints. I'm going to throw the same question to you. How are the risks going to evolve? What do you see the impact being?
Thank you, Andrew, and thank you to the IAIS for the invitation. It's a great pleasure for me to speak to this distinguished audience this morning. Rather than going through a list of risks, I think we've done a lot of that this morning, and to shed maybe a different light, I will share reflections on how all the risks that the world is facing are changing. And I would highlight 4 major trends which have impacts for insurers. Number one, the risks that the world is facing are becoming, whatever the risks, they are becoming more and more frequent. If you think of natural disasters, and Susan highlighted this, if you think of cyber, the number of cyber attacks has increased by 40% in 2022. If you think in terms of health, of chronic diseases, diabetes, neurodegenerative diseases such as Parkinson or Alzheimer. So whatever the risks, they are more and more frequent, one. Whatever the risks, they are more and more severe. Again, we've seen that with natural disasters. The average cost of natural disasters has been increasing in the past decades. A lot of that has to do with the fact that values and people are more and more concentrated. In 1950, 30% of the world population was living in cities. In 2050, 100 years later, 70%, 2/3 of the world population will be living in cities. More concentration values, more severe costs whenever there is a major disaster such as a flood. So more frequent, more severe, more connected, and Susan highlighted this as well. We've seen this in a very spectacular way during the pandemic. The pandemic started as a health and, sadly, mortality crisis. It translated, due to lockdowns, to economic crisis with the materialization of business interruption risks, a higher incidence of cyber events due to accelerated digitalization and remote work, leading to also a mental health crisis with the isolation that many people went through, and leading also to a social crisis, social unrest with the bigger divide between the haves, the white collars, comfortably sitting at home, working on their computer, and the have-nots, the frontline workers who were still continuing to make economies work, sometimes to the detriment of their own health. So more connected, more frequent, more severe, more connected, and I would add, fourth, more ambiguous, more complex to apprehend. A lot of that has to do with the expansion of intangible assets. 80% of the S&P value today is made of intangible assets, and 50 years ago it was 20%. Intangible assets are much more difficult to apprehend. How do you assess loss reputation? How do you decide there is a loss reputation? How do you assess the amount of the loss? Also, risks linked to new technologies, AI, the whole impact of AI on liability. Tomorrow, metaverse. Can I be hit in the metaverse world? What will that mean in terms of liability? So risks are becoming more frequent, whatever they are, more severe, more connected, and more ambiguous, more difficult to apprehend. So this has consequences. Now, if we move to the business of insurers, this has consequences on the insurability of risks. And there's a lot of literature, including in the Geneva Association literature, on the conditions for the insurability of risks. Well, when you go through this literature, there are several criteria. I'd highlight two. One is that risks have to be, or loss exposures have to be, independent and predictable, where if they're more connected, they're less independent. I've seen that again spectacularly with the pandemic. Also, the MPL, the maximum possible loss, has to be manageable. Well, if risks are more and more severe, the MPL becomes less and less manageable. So this has, and I will finish this to answer your question, Andrew, this has impacts on the business system of insurer, on their business models. Whereas insurers in old times were exclusively or essentially focused on risk transfers, of course, risk transfer will continue to be a key part of the value they offer, but we see the role of insurers and the industry expanding far beyond that, expanding ex ante in terms of risk education, risk prevention, risk mitigation, ex post in terms of support and accompaniment of customers, whether they are business customers or individual customers, in the case of a loss, in the case of an accident. And I would add a third implication for the business of insurers, which is working more and more in hand with the public sector. Because these risks are becoming more and more difficult to manage, the solution will not be just in the hands of the insurance industry. It'll be also a lot about sharing data analytics, sharing problem-solving approaches with governments at the federal level, at the state level for federal governments, at the regional level, at the municipality level, to address the risks and find the right solutions. Thank you.
Thank you, Jed. And I'm going to turn to you, Clement, now. In addition to all the work you do at IAIS, you're chair of the Audit and Risk Committee. We've been on so many panels together. You have a day job as CEO of the Hong Kong regulator. So I would like you to look at the same topic, but through the lens of the regulator. What impact do you see this having on you, on us as regulators? How are we going to approach it? And in a broader context, how will this affect the IAIS?
Thank you, Andy. I don't think I can cover everything given the limit of time, and we're going to have a second part of this discussion. So first of all, thank you for having me here this morning. Andy, I'm not sure you're my favorite commissioner in the United States, but you certainly got my favorite voice. So I think you guys will agree with that. Now, perhaps I will try to first latch on to what my three fellow panelists are talking about. The narratives are great because they all look at the same thing with different perspectives. But I would certainly look at it from a regulator's angle and cite 3 risks. I would tell the audience why they're important, both in terms of global context and sometimes in terms of my own jurisdictional experience. And hopefully, and they lead to the second part, which is what we're going to do in terms of standard setting, in terms of the SPFO in the next 5 years. The first one is probably it won't surprise you, is climate. And I would like to justify the reason why I cite this by 2 aspects. First, protection gap. If you look at net cat protection gap, globally 60%, and in Asia it's 85%. So there's a huge issue regarding how we can handle this particular risk and how we can handle it well. The emerging markets with their relatively low resilience and, as Jay said, a very rapid pace of urbanization is going to be hit hardest. Now, the second aspect which I wish to cite in terms of climate and why it's important is because of the fact that apart from what Jay has touched upon, that is getting more intense and more frequent, it is also extending and expanding. I tell you why, in the case of Hong Kong, for instance, we worry a lot about climate in terms of property damage because we have a lot of high-rise buildings. And we also have sometimes torrential rainfall, and therefore there are issues with water seepage and minor floods. But recently we got a new health hazard in terms of heat stroke. We have recently a couple of fatalities for construction workers working outdoor, to the extent that we now have to have a traffic light system for outdoor workers or indoor workers under an environment without air conditioning, and we have to provide for different work schedules. So climate risk will actually evolve, and it will expand into areas which hitherto you might not realize that it's going to hit you. Now, I'll move on to the second risk, Andy, which again has been mentioned earlier as demographic risks. Now, let's start with something which is probably things that we cherish. I don't know whether you guys are aware, Hong Kong people live longest. I think we edge just ahead of Japan for that matter. Gentlemen live 82 years, and for the ladies, 88. Of course, it's something that we cherish. But if you look deeper into the other statistics, it's a really worrying trend. For example, in 2018, which is like 5 years ago, people over the age of 65 make up 18% of our population. In 2 decades, it's going to increase to 33%, 1/3. To go with that, the dependency ratio, meaning the people supporting these elderly people, and I'm afraid could be one of them, is going to decrease from about 1 to 4 to below 1 to 2. So you can imagine the kind of situation we're in. And on top of that, we're in Seattle. We are a very compact society in Hong Kong. Just to give you a bit of context, the greater Seattle metropolitan area is 14 times the size of Hong Kong, but it's got 40% of my population. So you can imagine what kind of situation we're grappling with. So that risk is something that we will have to get to grapple with in the following decade. Now, finally, I'm reaching out to something which I know is not on the list of the polling question, but technology risk. And in the next panel, it's going to be called digital innovation risk. And here, I'm going to be very, very brief, Andy. ChatGPT, it hits 1 million users in 5 days. Compared with Instagram, guess how long? 2.5 months. And for Netflix, I'm afraid 3.5 years. So the pace with which this thing is moving is fast and furious. It's not like anything like before. Now, how do we deal with that? I'll conclude with this, is that traditionally, as a supervisor, we just promulgate more rules and regulations. In this case, like the previous panel, Cecilia said, it's not that easy. because it's not something that you really know. There's a lack of clarity, and it's moving very fast. It's like shooting at a moving target. I believe on this particular instance, the supervisors should learn how to master and harness that particular technology before we start to even think about issuing whatever rules and guidelines on that particular field. So Andy, I conclude with that. I'm glad to be able to be here again.
Clement, appreciate that. Now, sadly, as we all know, we don't have all the time in the world. I think we've got less than 8 minutes remaining in this panel. Can we bring up the results of the poll so we see what the audience thinks? And we can see that climate-related risk is at the top, followed by geopolitical risk and inflation interest rate risk. I'm just going to throw out a general question here, because I think Clement already gave his answer to this. Can anyone quickly tell me, is there a risk not on here, not on that list of risks, that you think should be on there?
I've got one.
Go right ahead. Jed?
Yeah. So one of the points I wanted to raise in terms of something that should be on all of our radar is the risk around distribution. I think Tom Bolt mentioned it in the last session. A lot of insurers, reinsurers are outsourcing, you might say, some of their core competencies to third parties. In the US, the UK, Australia, many of these markets, more and more business is flowing through MGAs, MGUs. It's a very lightly, or if at all, regulated part of the value chain of the insurance market. And I think if you've been around a little while, you've seen how badly that can go wrong where interests aren't aligned. So I think kind of that oversight around distribution, particularly in markets where the intermediaries control a large amount of business, I think that's one I would add.
Jed?
Yes, I would add something I alluded to earlier, which I don't see here, which is the risk of social unrest. For the industry to develop, there is a need for some sort of social stability. And wherever I look, I see that this is being increasingly threatened, amplified by social media, which very often manipulate, and there's a big question about the way AI is manipulating public opinions, but this is amplified by the way social media are manipulating public opinions. So this is the one I would add, social unrest.
Thank you. Susan?
The thing I would add, maybe it's a corollary to geopolitical risk, it's polarization and the inability for traditional the apparatus of government to take action, policymakers to take action to address some of these risks.
Thank you. All right, we've got, again, we're probably down to about 5 minutes left, so I'm going to turn this into a lightning round. Same question for everybody. IAIS meetings, everybody who's been to the IAIS meetings over the past few years, we know there's been that intense policy focus, the development of the insurance capital standards, for instance, other policy work. As we look forward in the second half of this decade, what standard-setting activities and should the IAIS be focusing on in order to address the risks we see before us? And I'm going to flip the order here, and I'm going to start with you, Clement, since I'm not your favorite regulator.
You might not. I did say you might not. I didn't say that you are not. Anyway, I think I'll save a bit of time to my fellow panelists on that, because after all, I'm a supervisor, so I shouldn't be monopolizing the time here. I'll just follow up on what I've said earlier. I believe climate and digital innovation are the two areas where further granularization of promulgation of better clarity in terms of standards will help. And I'll start with digital innovation. I believe that we should go back to basics. We might not be able to catch everything, which is still very rapidly evolving, but there are a couple of basics. For example, providing for greater operational resilience, because once you have that, even if things fail, you will be able to recover. The leakage is probably going to be controlled. We should have better clarity on accountabilities, because we talk about outsourcing, we talk about all these other things which actually tend to compute results, and how do we make people accountable for whatever outcomes which is being delivered by these systems. And further, I think we should avoid unintended consequences. One very often consequence being mentioned is about exclusion of certain groups, and which is probably unintended in terms of the application of technology. On climate, very simple, I believe that we're already doing an application paper which share best practices, best jurisdictional practices. I believe this standards is going to be able to provide greater transparency, and therefore will be able to guide the paced reduction of capacity in terms of the carbon-intensive industry, because I think that is something which is a very delicate balance. The audience will know that when these capacities contract, they will have consequential impact on economic development of certain economies, and I believe better transparency will assist in managing the process. Thank you, Andy.
Thanks, Clement. Chad?
Yes, I will not focus on what, in terms of standard setting, the IAIS should focus on, but rather how to get there. And I think what we are doing here and this type of event, which is stakeholder dialogue, is extremely important, because the times when regulators and supervisors would say, well, we've thought about this problem, we have the solution, this is what we are going to impose on the industry, these times are gone. And I think the solution, because the problems are more complex, more ambiguous, has to come from this dialogue. And actually, so I hope Jonathan will forgive me this. I understand the IAIS is wondering whether we should continue whether they should continue the IAIS Global Seminar in person. So we're going to do a poll, not a Slido poll. Who in this room think the IAIS should continue an in-person global seminar in the future? Thank you very much. Who thinks the IAIS should stop the in-person global seminar? Okay, well, I hope this will guide the IAIS. I apologize, Jonathan.
Was that Jonathan's hand in back?
Thank you, Andrew.
Thank you. Stefan.
Right, so I'll choose one. At AM Best, we do an assessment of the enterprise risk management capabilities of all of the insurers and reinsurers we follow. And speaking back to the resilience, 90% score at an appropriate level, meaning we feel that their risk management capabilities are in line with the risks that they choose to undertake in their business. Where a lot of insurers fall short is their stress testing capability. So their ability to really take, and kind of picking up the theme from the last panel, we're in, you might call it a perma-crisis or a poly-crisis. The environment is so dynamic, organizations can't look at their risks in a silo fashion. They need to have a robust stress testing approach to inform them in terms of their risk appetite, risk tolerances, as well as kind of monitoring those levels to the extent that they become breached. So I think that's hugely important for kind of the regulatory supervisory community to pick up.
Thanks, Stefan. Susan, you get the last couple of seconds.
So Jad was very eloquent in his characterization. We start with the how, what's the problem we're trying to solve, and how to do it. I'll be less eloquent and more pointed. What we would say is that how can we regulate or set standards should not be the first thought. It should be what tools do we already have in the toolbox as it relates to regulation and standards to address a problem. There's always a cost to regulation, and one of the reasons that I think we as an industry feel, representing the industry around the globe, that we can weather the current storm is because we're good at asset liability management and we are already highly regulated.